Hi everyone. Today we are going to see about the valuation of shares. Need for valuation at the time of amalgamation of the company, when loan is granted on the security of the shares, when preference shares or debentures are converted into equity shares, when equity shareholders are to be compensated on the acquisition of their shares by the government under the scheme of nationalization. Now we're going to see factors affecting valuation of shares, nature of business, demand and supply of for shares, government policies, past performance of the company, growth prospects of the company, the management of the company, economic climate, accumulated reserve, prospects of bonus or rights issue, dividend declare. These are the major factors affecting the valuation of shares. Next we're going to see about the methods of valuations. There are three methods of valuation of shares. First one is net assets basis, second one is yield basis method, third one is dual basis method. Net assets method, excluding goodwill, the net tangible assets are taken for the calculation. Net tangible assets equal to assets minus liabilities. All the assets are taken for the calculation in the market value. Fictitious assets like preliminary expenses are excluded. The formula for value of shares in net assets basis method is net tangible assets divided by number of equity shares. Net asset method including goodwill. In this method, goodwill is included with other tangible assets for the valuation of the shares. Goodwill is taken at its actual value, which may be equal or more than or less than the book value. There may be some value of the goodwill even if it is not shown in the book. For example, assets rupees 10 lakhs, liability rupees 2 lakhs, number of shares 50,000. Value of shares equal to net assets 10 lakhs minus liability 2 lakhs divided by number of shares 50,000. So per share value is rupees 16. The second method is yield method. The following steps are to be taken for calculating the value of shares under this method. First one, calculation of average expected future profit. Second one, calculation of unexpected return. Third one, value of shares, expected rate divided by normal rate into paid up value of one share. For example, 2009 percentage preference shares of rupees 100 each, rupees 2 lakhs, 50,000 equity shares of rupees 10 each, rupees 8 per share paid up, rupees 44 lakhs. Expected profit per year before rupees 2 lakhs 80,000, rate of tax 40 percentage. Transfer to general reserve every year 20 percentage of the profit. Normal rate of earnings 15 percentage. Calculation of profit available to equity shareholders. Expected profit before tax is rupees 2,18,000. From this we want to find out tax at 40 percentage. So that amount is 87,200. So we want to less from this net profit. Profit after tax is 1,30,800. From this amount we want to take general reserve 20 percentage. So after deducting general reserve, the profit is 1,04,640. Less preference shares dividend 9 percentage from rupees 2 lakhs. That amount is 18,000. So the total profit is 86,640. Calculation of expected rate of earning. Expected rate is equal to profit available divided by total paid of equity. Share capital into 100 is equal to 86,640 divided by 4 lakhs into 100 is equal to 21.66 percentage. Calculation of value of equity shares. Value per shares minus expected rate divided by normal rate into paid up value of per shares. 21.66 percentage divided by 15 percentage into 6 rupees equal to 11.55 rupees per share. Dual or fair value method means it will be the combination of both method. It is simplified combination of the previous two methods. According to this method, valuation of shares equal to net assets method value plus yield method value divided by 2. For example, net asset method value is rupees 10. Yield method value is rupees 12. The fair value is equal to 10 plus 12 divided by 2 is equal to 11. In the dual value or fair value method means it will be the combination of net assets method as well as yield method. We want to add net assets method answer plus yield method answer divided by 2. Kindly answer the following questions. The valuation of shares is a complex process that involves assessing a company financial health, market positions, and growth prospects to determine its dash. Second question. Investors often use various methods such as discounted cash flow analysis and comparable company analysis to estimate the intrinsic dash of shares. Third one, factors like earning per shares, dividend history, and overall performance of a company play a crucial role in the influencing of the free perceived dash of shares.